We're fortunate to have David Hunter with us today, known as Dave H. Contrarian. You're here on TradeGATEHub.com. Welcome back to TradeGATEHub, David. Great to see you.
Yeah, hi, Dale. Thanks for having me back. Great to see you too.
So has your confidence been reinstilled into Paul? Do you think he's finally got it correct?
No, probably quite the contrary. I think he's
Okay.
blowing it big time. He is struggling. He's got a tough job, but I really think not just him, but the entire FOMC is really gonna have. They're probably gonna go down in history as the worst Fed that we've had. I mean, I think there's a policy error here that's going to be huge.
Okay, so maybe the end of the Fed by the time it's all over. What do you think? A lot of people are hoping that happens.
Yeah, I don't think so. In fact, I think in spite of the mistake they're going to make, we're going to need the Fed more than ever because of that error. I mean, they're going to have to bail us out because they're sending us into global bust, something I've been talking about for a long while.
Yeah,
and it's going to be, in my opinion, the worst economic downturn we've had in 80 plus years, and potentially the worst financial crisis we've had ever in history. So, and it's global. It's not just the Fed, but the Fed is the lead guy.
Yeah, I remember one of our previous conversations. I asked you, I said, David, when do you think we'll enter a recession? You said we're already in a recession.
Yeah, I still believe that. I know the debates out there, et cetera. Everybody's wondering whether this redefining of the recession by Biden administration means anything. Is it going to postpone anything? I said that's just political spin. That doesn't affect the markets in any big way. They understand what a recession is, and there's still debate going on because certain aspects of the economy still look strong. But I think when the recession gets dated, as it always does after the fact,
yes,
as is usually the case, we're going to go back and probably find out it started well before we thought. So, I think we're in it now. I think we've been in it, the entire second quarter. So, they can talk about, the strength of the economy all they want. There are a lot of disturbing signs that say not only are we in a recession, but we're headed for a lot worse.
Okay, so listening to you talk, most people wouldn't think that you would have a target that you have for the S&Ps, right? And Dave, I want to talk about it because I'm a fan too. I like your work. I believe in the narrative, and I've made a few attempts to top pick the dollar and bottom pick the precious metals, and my timing wasn't perfect. So I know the rest of your fans would probably like to know, because they go through it themselves, how you were able to maintain your conviction, and especially if you had positions on, how you were able to, what was your self-talk when this decline extended maybe another 10% and lasted maybe another 3 months longer than you thought it would. Tell us how you stuck to your guns.
Yeah, first of all, having been a contrarian through my entire 49-year career, it's not like this is the first time I've been here.
Okay.
I've been wrong before. I've been early before. In fact, I'm often early, as a value manager, as a pension fund manager, which also tends to set you up to be early. So that part of it was not hard to say, hey, how come this didn't happen when you expected, or how come it's taking longer? That's the nature of markets. You've been in this a long time like me. That sometimes you're going to hit it spot on, and sometimes you're going to not. And so that doesn't bother me. I mean, it's always uncomfortable while you're waiting. But
probably more so for the people, and there's my first interruption of our interview, probably more so for the people that are following you that do not have that life experience in the markets than for you. And
the biggest,
a lot of hand holding went on, right?
Yeah, the biggest part of the a lot of the debate or criticism I get on Twitter comes from, and people think I'm picking on traders. I'm not. It's a different aspect of the investment business. Traders are an important function, but retail traders, unfortunately, don't really have the experience or the knowledge to understand that, trading is just one small part of this, and they tend to be very impatient. I ran trading desks, or I oversaw trading desks in my buy side career, and traders have a different mentality than a longtime investor, and so they run out of patience when things don't happen like clockwork. I make forecasts a lot of times expecting the opposite to happen for the next month or two. Like in January, when I said we're going,
Right.
we're going to have 6,000 on the S&P. I'm raising my target from 5,300 to 6,000. I did that at the beginning of January when my letter went out and was talking about a correction of 10%. And so people on Twitter a lot of times hear the forecast or see me write something, and they think I'm saying it's going to happen tomorrow or today. And that's not usually the case. I'm looking out. So they need to understand that a macro forecast, I don't just say this to have an excuse. A macro forecast is not a trading call. It's something, it's a cycle, and a cycle can happen.
It's a positioning call, which could be a year or two for the position to work out.
Yeah, but it's not even that, Dale, because it's truly a forecast. The position, I might not, it's not like when I say it, I'm taking a position because I'm long-term and I can ride through that. When I say it, I'm talking about what I think is coming in the big cycle, what is coming in the next, so sometimes it can be something that may take a few months to start working out. And the other thing I say on Twitter a lot, and I'm not sure is well understood, is let it play out. And that means the economy and markets that respond to, movements that respond to the economy play out over time. So if I'm usually the earliest one out there to spot trends. So when I start talking about, rates leading the Fed, it takes a while to see that. It's not something, people want to say, okay, I waited a month. That's a long time. No, they play out over months. They don't play out over days or weeks. So you just have to, maybe it's learning my language and learning who I am. But too often, what I call the Twitter trader trolls, and there's plenty of traders that aren't trolls, but the trader trolls are jumping on me because they don't understand. It's their.
How about your subscribers, David? I know you write a newsletter. Were they, sometimes I know I've written things, and if I'm wrong for a while, I lose subscribers. In my business, I'm no more of a trader. Only good is my last trade. Did you have any loss of subscribers during that period where it broke another 10%?
Well, I have obviously it's an annual subscription, so I have people coming up all the time.
Okay.
My renewal rate is something above 35%. Sometimes it's, it might have slipped from over 40 to 35, but I didn't see a big drop in that. I have seen a little bit of a slowdown in people asking for new subscriptions. They were coming fast and furious, and in the last few months, obviously with what's going on, it's less. But generally, most of my subscribers understand. I get a few that when they leave, they're not happy or whatever. But by and large, most people that are subscribers, even when they leave, say, I'm just not in a position to renew. I like what you do, but so I'm not. I think it's because the letter is, I get to explain my longer term rationale there better.
They're used to your style.
Yeah, in a tweet, it's not quite as easy to lay out the whole thing. But that being said, I create some of the problems for myself also, because I say I'm not short term, and then I'll put something out like I have recently, which is calling for a move back to 3,800 before we go. That we could have a pullback here of some substance. So. And then they say, well, yeah, you want it both ways. You tell us whenever it's not working that you're long term, but then you do this. It's not that. My forecast is the bigger picture. Yeah. But when I see a setup, I'll put it out there. But it's not with the same.
Yeah, not everyone's no one's 100%. Paul
Right.
Tudor Jones,
Yeah.
no,
Not,
no one's 100%.
not even close. No.
No. So, I mean, if your hit rate is, above 50 and money management, you're going to be successful. So here we are in the S&Ps, and this 4,200 is kind of the battleground that you're looking at for maybe a pullback to 39, 38 before the next move. Maybe that begins tomorrow because the market might get stronger than expected numbers for the NFP, and yields rise again.
That's a good point. I think right now we're in a mode where bad news is good news. Good news is bad news. Because everything that's going to determine this run is the Fed backing off from their tightening. And so right now, the street ran ahead of itself. Yes, it ran ahead of the Fed last week. They misinterpreted Powell, and I said it at the time. I said I didn't get the same vibe the street did.
Yeah.
That the Fed is ready to pivot. I don't think they are at all. He made the mistake of talking about a neutral rate, that they had gotten to the neutral rate, and I think people ran with that. But basically, Powell is still in the camp. He's still a believer in what Dudley has been pushing, and I think Dudley's going to go down in history as a bad, making some pretty bad speeches here. But Dudley's been pushing. He started in April, and then he's come back again in July, pushing the idea that we have to get the stock market down a lot lower, or we're not going to get inflation down. Yeah. And we have to get financial conditions tightened, and the only way we do that is a much lower stock market. I think that's ridiculous for a Fed member or a past Fed member to push that out as a policy. And Powell has bought into that hook, line, and sinker. So when he sees the market run like it has since last Wednesday's Fed meeting, he gets nervous. He goes, "That's not what I want. I want the market down because Bill Dudley tells me we need that." So I'm being a little sarcastic, but yeah. So
yeah, even Neil Kashkari, David, who is Super Dove, is talking about there's more wood to chop.
Well, it's pretty clear that, and I called this last week in a tweet. I said, you're going to see the Fed send out its people to talk this back. So that's Mary Daly, Kashkari, Bullard on CNBC yesterday. Those were, I guarantee you, those were requests by Powell to say, get out there and talk this thing back the other way. And so not only did they talk it back the other way, you could tell they're trying to talk it in a very extreme way or strict way, serious way, that there's a lot more to go. I mean, they want the market down. They I don't know what number they have in mind, but I think they believe the market should be down towards 3,000. And I think again, I think it's the last thing the Fed should be doing, or a Fed member should be doing, is positioning policy based on the stock market. And for years, I know we felt that the Fed had there was the Powell put, that the Fed was, running policy to keep the stock market propped up. And now we have, the sense that the Fed is trying to get the market down. They should do neither of those. Their focus should be, as they keep claiming it, is inflation and unemployment, or inflation and the economy. My whole thesis, and I feel, I still have the same convictions I've had, my whole thesis rides on the fact that the economy, all the leading indicators, all the things setting up here are pointing to an economy that's going to get a lot weaker in the next several months, and that it's going to wake the Fed up in a big way, in such a way where they go, oh my God, we went too far. We got to really turn around here. And that's where you get the response, much bigger response from the market. So it will happen before the Fed, because the bond market is going to lead the Fed. The bond market already knows that the economy is weak and that there's real problems ahead. Look at housing. Look at the inventories that are building in retail and housing. Look at the weakness across the board. And it's, as we know, inventory corrections is a definition of what a recession really is. We've got probably the biggest inventory correction coming in your or my career, or certainly one of the biggest. So So there's some real trouble ahead. And the problem is we have a Federal Reserve led by a lawyer that thinks that we have to, we have to run policy based on the headline number that comes out each week. Gee, CPI is 9%. That must mean inflation's, we haven't done anything yet. No, that's a laggard. Take a look at the things that lead inflation, like some of the commodity prices that are nosediving, and take a look at the things that lead the economy that are nosediving. And that'd be bad enough if we weren't in a cycle where leverage is through the roof. I mean, we've never had debt and derivatives at these levels. This is all uncharted territory. You make a mistake in this kind of an environment where leverage is that high, the mistake gets magnified many times. So not only are they making an error, the Fed's made errors every cycle and caused recessions, but this time they're making a bigger error and they're making it into a much higher risk environment. That's the whole story.
Yeah, they're sowing the seeds for what you're looking for, the bust.
Right.
So, I think there'll be a lot more people agreeing with the bust, and a fewer people, which probably makes the market bullish, believing that the S&P can trade to 6,000, because who wants to buy this market? It's still under-owned, even though there might be a correction, right, Dave? I mean, hedge funds and Goldman and COT and people here on the news, recession, China, Ukraine, the Fed. Is that the environment where people say, hey, I got to buy some stocks? So it'd be a wall of worry all the way up?
Yeah, it's a wall of worry, and that's, you're right. That 6-9 months ago, nobody agreed with my bust call. They thought that was crazy.
Yeah, right.
Now everybody agrees with the bust call, and they tell me there's no way you're going to have a melt up. So
exactly.
So yeah, that's sentiment. That's what happens. And we're looking at short sellers are more short than ever. There's lots of things out there showing that investors are very positioned for the downside. And when they get a surprise, and it's not going to be in the next couple of weeks, but when they get a surprise with the Fed waking up and saying, whoops, I guess we did go too far and we have to pivot, that will cause everybody that's positioned for the downside to have to reposition for the upside. And it'll start with short covering. It will move to those seeing some of the signs that things are, that there are bright lights out there somewhere over the horizon. And then it'll move into FOMO. Once it moves into FOMO, you'll start seeing the parabolic.
Yeah, I think a lot of the bears, David, in my view, are going to have a hard time rationalizing being bearish once we close, say, over 4,300, back over the 200-day.
Yeah.
Don't you think?
I think 4,300 and then 4,600, I think, are the two liftoff points. And I tend to think, as I said, that we're gonna, it's pretty obvious the Fed's going to do all they can to jawbone the market back down. You could get a CPI, I think it's next week, that could be still very high.
Hot.
And, hot. So that, all those things, all of a sudden, this run up we've had that's more than 10%, I think can be given back. So I see on the charts an inverted head and shoulder setup. And so
on the S&P, so we could form a right shoulder right here. Here's your left shoulder, here's your head, and maybe a right shoulder. The symmetry would be 3,800.
Yep, just about. And not surprisingly, there's a gap down at 3,800 that could be filled. So does it have to happen? No. As I've said, when the melt up really gets going, these kind of setups are going to be the things that fake you out, and then it's going to keep running. So I'm not saying this setup is a high conviction, given, but I do think it's a real possibility given all the circumstances out there. It seems like, and it doesn't have to happen right here. It can run up towards 4,300 and have a little bit of a, cockeyed right shoulder, but I think that's what we're looking at. And I think it lasts, couple weeks. It could last longer, but I think probably a couple weeks.
Let me ask you this, and I want to go to yields. How long do you think it's going to take to complete this melt up? Are we talking about it being an early 2023 story now for it to happen?
Let's put it this way. I've always said, it's going to be steeper than the last leg, which was the, March 2020 to December 2021. So I know it's going to be steeper than that and shorter than that. So it's going to be, somewhere between 3 and 9 months is my guess. And I have narrowed that down typically to 3 and 6 months, because I think we have, as you say, the seeds are sown for a bust that's not too far out. So I think it's going to be the setup is there for everybody to come through that door at once and try to get into the market. I think it can, as crazy as it sounds, you can go from 3,800 to 6,000 in 3 or 4 months, or it might take 6 or 8 months. But either way, whether it's 3 or 4 or 6 or 8, that's unheard of. I mean, that's a move that we have never seen before in that kind of magnitude in that kind of a tight space. So
yeah, it's a blow off.
It is. Yeah, melt up, blow off are basically the same terms.
Yeah.
And then you get into a top that I think will stand for decades. I think whether it's 6,000 or a little above 6,000, I think that high water mark is not going to be seen again for decades, not 1 decade, but decades.
Wow.
And I don't know whether decades is 2 decades or 5 decades, but it's going to be a long time.
Like I said, you're the most bullish bear I know. And, anyway, I look at the yield chart here, David. Do you think that's it? And we're not going to see 3.5 on the 10-year again? And I think I saw a tweet where you thought the bond market had put in a major low, and that this might be the time that before it's over, we'll be looking at 0 or negative rates.
Yeah, I definitely think the 350 or 347, wherever the 10-year got to.
Yeah,
I think that's the high watermark for this cycle. I've been in the last week or so talking about the 10-year moving back over 3%. I think I said that when we were at 360. We moved down to 355 or thereabouts, and then went up to 380 or wherever. I mean 280. 260 up to 280. I think we can get over 3, maybe up to 310 or 20. That's as high as I see rates going if they get that far. And I think that coincides with this pullback in the market. So, it'll be the same rhetoric of, gee, the Fed isn't done. There's higher rates to come. There's inflation still a problem. So I think the next 2 weeks, you could get a backup in rates over 3. And then from there, I think it's all downhill to 0 or negative rates on the 10-year. So I think we will, in the middle of the bust next year, I think we will see a negative 10-year, as unbelievable as that is. And it will come as a result of the biggest, as I say, the biggest downturn, global downturn in 80 plus years, and a financial crisis unlike any we've seen, including 2008-9. That will require the central banks of the world to pour money out at rates we've never seen before. Many times what we saw in the last 2 years.
Yes.
That means they'll be buying bonds like crazy. So, they won't have a choice, because they're going to be trying to stop a free falling financial system.
Okay. So, I remember you calling after, not knowing about the war and thinking, crude was stopping here. I remember your tweet right up here that you wouldn't be surprised if this was the high. And I think there was, some type of OPEC meeting there or something, and oil looking pretty negative. You've got that right. Still looking for on this cycle, maybe $60.
Yeah, I think short term, again, here's where I can get in trouble.
Yeah, but it's going to pop.
I think short term you could get down to mid 80s, so 86-ish, and then pop up to 110. And then from there, I think you go down towards the 60s, and ultimately in the bust, I think you get down into the 30s.
Okay, so just a quick line there. So also the dollar, David, I know you've been looking for a top in the dollar. Was that it above 90, above 109? And
yeah, I think so. Obviously, I've been fighting this thing, the bull run that it had.
Me too.
But I do think we've seen the highs, and I think that's going to be part of the story for the run to 6,000 as well. I think the dollar is going to be coming down. The big thing that will turn all of these things together is the Fed pivot, obviously. And for a long time, I've been saying, Fed pause, because I just had a hard time seeing where they were going to go from pause to pivot, given their mindset. But I think by the time we get into the fall, things are going to be so bad, I think, in terms of housing and retail, et cetera, that I think they may have to even pivot.
Is the consumer broke and that's why they're running up their credit cards, David? They're living off them now?
Yeah, the consumer's in trouble. They drew their savings down. Now, you hear stories about, checking balances are big, and, the consumer's not in bad shape. I think there's a have and have not, as there has been for a long time.
Yeah.
And I think the low end of the consumer and up into the middle class is in trouble. There's many people that never went back to work. They were living on the handouts from the government. And so that's part of the problem. A lot of people, I think, for a while were living off stock trades and crypto trades. I think all those things have gone away for them. And I think the consumer's going to be in big trouble, in the next year.
Okay, so with that happening and your view, what supports your view with real yields falling is that there should be some type of super bull market that's either started or around the corner in silver and gold.
Absolutely. I think there's very little downside. They'll probably in the next week pull back a little more. The miners have some gaps to fill, but everything I look at there says we're in a bottom there, and there's big upside. I think silver and gold are about to have their big run. So I've got 3,000 on gold pre-bust, meaning during the melt up and maybe a little after the melt up in stocks. And silver to 50, and I would not be surprised if 50 is too low. So those are huge runs from where we are, and certainly not everybody's kind of given up on these things because they've been such terrible performers for a while. But I think we are putting in lows in silver, gold, and the miners. They all look like they're poised for much higher.
They may be outperforming even strong groups like the semis on this run. They may dwarf them. What do you think?
I think so. Yeah, I think so. I mean, my call on GDXJ, which is a junior gold ETF, is that it can get over 100. If you can go from 30 to 100, you're going to outperform pretty much everything.
Okay.
And I think, and the silver miners can even do more than that. So
yeah. And also something else that you talked about quite a bit is that you felt that on this blow-off rally that the Russell would lead it. And I've seen charts, and I thought of you, how the Russell has begun to change. Its trend is shifting. It's closer to its downtrend breakout than the S&P. It's outperforming the S&P. You look for a continuation of that during this scenario.
Yeah, I do. Now they can have a 10% pullback here with stock market correction, but I still look for 3,000 on the Russell in this this blow off. So from here, that'd be a heck of a run. That would outperform. I think that would outperform the Nasdaq. I mean, if you think about it, all this dollar strength is going to hurt. The international companies' earnings for in terms of currency translations for a while there. Even though I think the dollar is peaking, the small cap index is much more domestic oriented. So I think you're going to get that benefit for sure.
Okay. Well, David, I want to congratulate you on sticking to your guns and seeing that, there's some vindication with the recent action. And I have to say, it certainly took a lot of intestinal fortitude, if you know what I mean, to stay with it.
It's not fun when when the markets are going against your call. People think you get everything thrown at you. So, but again, what gets me through this more than anything else is conviction, and it's not false conviction. It's, comes from experience.
Two big trades in front of us, the melt up and then the bust. So why not build your grub stake being long for this melt up, and then go to cash or learn how to be short after that. And David, I'm sure we'll be talking as we approach that. That's going to be a even more exciting time. But this is going to be a heck of a roller coaster ride up to 6,000 too.
Yeah. By the way, if I know a lot of people out there have been saying we can't be starting a bull run here with the VIX never getting above 35 or 30.
Oh yeah.
And if we get that correction back to 3,800, I bet you see the VIX over 40.
Really? Okay.
Yeah, I think that could happen. I mean, I don't follow VIX closely, but that's a 400 point drop from here on the S&P.
Yeah.
I don't think people are going to just sit and take that as a correction. You're going to have a lot of people bringing back out the calls of 3,000 and 2,000, etc.
Yeah, that this is a bear market rally terminating and we're headed to new lows.
Exactly. Yep.
Got it. Dave, appreciate you being with us. And the H today stands for hero. Dave H. Contrarian, a hero instead of a zero. And definitely great research, Dave. And I follow your narrative, and I'm looking forward to trading it and participating it in different asset classes that you've covered today.
Yeah, thanks, Dale. I'm definitely not trying to be a hero. I'm just trying to call what I see, but appreciate you having me on.
Yeah, sometimes you have to be a hero for yourself when things aren't going your way. The difference is when a fire gets knocked down, it's not that he gets knocked down, it's that he gets back up.
Yeah, by the way, I talked about my letter before. If people are interested in it, the best way to find out about it is just to direct message me on Twitter, and I'll provide any details.
Okay, and that's at Dave H. Contrarian. Thank you, my trading warrior brother, for being with us today. Really enjoyed catching up.
Okay, thanks, Dale, and stay cool.
Okay, we'll talk soon, buddy.
Take care.
That's a wrap, everyone. Hope you enjoyed Dave, and Dave will be back with us. We'll talk again in the fall. Okay.
Sounds good.
All right, that's a wrap, everyone. Good hunting tomorrow on the NFP. For me, it's no frickin' problem. And I'll talk to you guys tomorrow. Adios. Thanks, Dave.
Bye, Dale.